Never
What do you
been on
think?
TV before.
How do you like this show so far?
I think it's great. I'm a big fan of liquid lunch.
Are you
so
really?
exactly, and the implications of a liquid lunch, all that stuff.
And there are only implications at this point, sadly. Are you? But you're probably driving anyway, right?
Exactly. No, I'm from the eaters, not the drinkers. So.
Oh, okay. Well, actually, I had a liquid lunch today because I came in, John, and I found somebody had put some of that Ensure in the fridge.
Oh, is that right?
Yeah, and I thought, you know what? I think I'm gonna have myself a liquid lunch.
I had a liquid. I had a liquid lunch too.
Did you?
Yeah, I had a martini.
No, you didn't.
Yes, I did.
Not today.
Yeah.
No.
Did you?
Yeah.
No, she's
To get
not,
loosened up for the show.
Yeah. Got to
Exactly.
loosen
Get
up for
you
the
in the
show.
mood.
She's not drunk at all. I can tell you. She's got no.
I'm getting so good. Look, I'm getting so good you can't even tell.
Yeah, exactly. Okay, John. Great to have you here.
Good to be here. I'm delighted you invite me out. Thank you, and always enjoy participating.
Well, you know, John, it's you brought a lot of notes today, and I guess we're talking about RSPs. Is that what you said?
Yeah, 'tis the season, right? So everyone knows that January, February is when people start thinking about making RSP contributions.
To reduce their tax burden.
Exactly, reduce their burden.
Yeah.
Taxes. Yes, exactly. So everyone has till March 1st to do something. So there's a lot of media exposure about this, and I thought it'd be a relevant topic to come out and talk to your listeners about.
Okay. Well, where?
How do you want to start?
Where do we begin?
I think that's a good. I think what you'd like to start with is just talk about the problem that exists out there, the retirement problem,
Yeah.
and that is you take an average 35-year-old, and I don't know what the demographics of your listenership but I figure that's not far off.
It's pretty accurate.
Pretty accurate, especially the ones on Pluto, the satellite listeners.
Who told you about that?
I did. Okay, fair enough. But you've got 360 months till retirement. It's not. It's an imaginable number, and the problem is that to accumulate the required funds, it's challenging. And there's a couple of problems with doing that, and one of them is, and if anyone has kids who's listening to this, they can relate to it, that you're earning your money, you're spending it, and there's only a little fraction left there to use towards this sort of funding. And it's actually a demographic problem. And the other issue is that a lot of people have is just knowing what's available. So for instance, there's really only a couple of sources to fund your retirement. One of them is government benefits. Now, I don't know if you've looked, Marla, at what the government's going to give you at the ripe old age of 65. Are you familiar with those numbers?
65, yes.
I know you're not familiar with that number.
I don't know.
What's that?
I don't know what the government is going to give
Well,
me.
it's humbling. It's about $20,000 a year. And what they're finding...
That's what I make now.
Yeah, to
so
me, that's
I'm
good
used
money,
to that.
John.
Yeah, to me, that's good money. So honestly, I'm used
You're
to that.
happy.
I keep my
You're
overhead
happy.
so low that I can go to Morton's once
See?
a month for dinner because my overhead is so low.
I
Exactly.
like that. Well, and that's great if you can swing it. Remember that, and that's into sort of tomorrow's dollars. The issue is, though, if it's truly poverty, and for most Canadians, and
it may not even be there, right, John? Because, I mean,
Yeah,
the
right.
way the demographic time bomb that's ticking with more and more people going to be
Right, that's
hitting
what
that
they keep
retirement
threatening
age and
is
less
that
and
we're
less
not even
people
gonna
there to
have the
support
pension.
it.
So are you asking me? I've spoken to them at CPP. We're well funded.
Really?
Well funded until we're all about 100 years old. However,
Fine.
what will 20 grand get you at that point? That is the problem. And so you have to look at alternate sources beyond. The government isn't going to take care of you.
Of course you should, and you need to, because people want to live as good as they can.
Yeah,
Exactly.
But John, you save and save and save, and at 65, is that when you can start cracking into it and get the payments out?
You can crack into it anytime.
Yes, I know, but it's
Freedom
very
55,
it's
right,
very
John?
expensive to do that tax-wise.
Well, so that's a great. So you're asking a loaded question.
Well, what is I've gone blank. So is it 75? Is it 70? Is it
So
65? When you have to, when the government says you have to.
Let's talk about some RSP rules. I think that would be a good place to start, and then we'll talk about some tips as to how you can sort of plan effectively when it comes to RSPs. So the RSP rules is you can contribute for 2010, which is what everyone is contributing right for, $22,000.
In 1 year?
Up to 18% of your income based on 2010. And in 2011, it's 22,450. So 18% of your income or 22,000, whichever is...
Well, if your income is 20,000, then you're not going to be contributing 20,000.
Right, so it's 18%.
Right.
It'd be 18% of
So
your
let's
income.
just call it 18%.
Okay. At 71, you have to pull it out.
Okay, so it's not 65, it's 71.
Now-
and what is that called?
When you withdraw your RSPs, it's called you turn them. Well, there's three things you can
No,
do.
the government sends you, it's an R something.
It's a registered retirement income fund, a RIF.
That's it. Thank you.
There you go.
So it's
See?
a RIF. You have to do the RIF.
You have to.
And it is designated, a certain amount is designated by the government.
Yeah. There's three things you can do with your RSPs at 71. You can either create a RIF, which is sort of what you do is, and here's the plan, right? You keep socking this money all away for your entire life, and then at 71 you start drawing it out. Now, there's three options. You can take it out as cash, but let's say you were one of those little whippersnappers. That's actually a bad word, I hear. But you were a youngster and you started when you were 19 and you accumulated $1 million. The last thing you want to do is cash in $1 million because that means you just blew your whole tax strategy. You're taxed on this full $1 million. So what the government came up with is they came up with RIFs, which is a way of staggering your income. So they force you in year one to take out about 77% of the amounts in your RIF. So they don't force you to take the whole thing out. And that's taxable, and then the percentages keep increasing. So yes, those are the rules with respect to what you have to do with an RSP.
Yes, and what is the percentage that you are forced by the
7% in year one.
7%.
Of whatever is in there. If you had $1 million
Right.
in your RSPs.
Okay, and can I tell you already the flaw to that system?
Go ahead. There's a lot of flaws to that system.
Of course. And if the longer you live, the more you experience, the more you see that I've certainly had somebody in my family die at 73, and the RIFs were barely, depleted, and then half of that goes to taxes. And so what was all that hell for?
Exactly. And that's
why I'm not doing it.
I don't blame you. There is problems with RSPs. They're not for everybody. If you talk to any well-heeled seniors who own RSPs, they don't like them at all. In fact, anyone who has sort of an income in retirement through a business, any amount you withdraw from an RSP is considered income. So you might find yourself in a higher tax bracket in retirement than when you were working, which is exactly what your relative talked about. Now, the reason we came on to talk about RSPs is because it's on everyone's top of mind.
Yeah.
But they're not for everybody. You're absolutely right, Marla.
Let's say why are they not? Because I'm the only one amongst my friends going, because I started mine at 16.
Yes.
So I was actually smart then.
So just
I've
5 years ago.
accumulated quite.
There you go.
Are you married?
Yeah,
Are you married? Can we go out then? That's very good.
Yes and
But, yeah.
That wasn't in the interview.
And so, but at this point, I don't want to contribute anymore.
Yeah.
I don't have children. I have no one to leave it to. The lawyer says leave it to charity.
Yep.
And I said, well, when I find one that doesn't steal and buy the staff's lunches and new pens, I'll give my money to the charity. But until such time, anyways.
No, you bring up a good point. Should you?
Yeah.
So
I stopped, and actually my accountant said, yeah, you probably should stop.
Yeah.
Because live with your money,
Yeah.
enjoy your life before you die.
So you got to again, and I don't know your financial situation. Everyone's different.
You won't know until you take me out, big guy.
Boy, I guess I need some clients this week. Okay, I'm just kidding. No, so I don't know your situation, but if you were in as you know, there are marginal tax rates, and there's some pretty hefty ones. If your income is over $103,000, you are taxed at 46.7%. Every dollar that you contribute to an RSP will bring your income down, which means every dollar you contribute to an RSP, you'll get a 43.7% return. That's an excellent reason to contribute to an RSP. If you're in a low tax bracket, in the 18 or 20%, you're right, it doesn't make much sense. And that's where something like a tax-free savings account might make more sense. Have you heard of those?
Yeah, sure.
Okay.
And I put it in $5,000 a year.
Okay, that's right.
Yep.
So the tax-free savings account works differently than the RSP. The RSP actually reduces income. So if I have a client who says, I'm making $150,000 a year as my T4 income, which is what Revenue Canada thinks I earn, should I contribute to my RSP? Probably, because every dollar you put in, you'll get a 47% refund on, right? It's not a bad rate of return, 47%. They're in a lower tax bracket. I might say to them, well, the refund's not so great, and you get nailed when you draw it out.
And remember, it's 47% of that amount that you pay in. It's not of your entire income.
Right.
So it can't be, people go, oh, wow, that's great. But it's actually
marginal.
very small. Very
it's
small.
marginal. It's a marginal tax rate.
It's like your tax breaks on your medical expenses. It's only a percentage.
Right.
So go on.
Well, it's okay. So yeah, you're talking about marginal versus average tax rates. I understand. So, but people are well entrenched in that 46.7% marginal tax rate. So everyone's different. So the RSP though does reduce your income. The tax-free savings account, which we should also address, is a great vehicle for accumulating money. However, it does not result in a deduction of your income.
You just don't pay income tax on your interest.
You got it.
So, and you can, the maximum amount is $5,000 a year.
Right.
So you put in $5,000 every
You
year.
got it.
You're not being taxed on the income. You are getting interest. Sorry, and you can take the interest out.
Absolutely.
And you can take some of the money out. But
Absolutely.
I can't remember. Do you have to keep the principal? Do you have to keep the $5,000?
Nope.
So that money can come in and out.
No. In fact, there was a little bit of a problem with it in the first year. I'm not
So
sure.
people were all putting it in and then
They were
taking
putting
it out?
it in and taking it out and putting it back in again.
Right.
And the government said, oh, you over-contributed. So they changed the rule.
So what's the rule now?
Well, the rule is
exactly?
you can take it out and put it back in.
So you can.
Yeah,
So,
absolutely.
So
They changed it because it was caused wrong. Well, they just came up with it. It was a new idea, and they realized there was a flaw with it.
Maybe what they should do is, say, but you have to keep in $5,000 no matter what, at least for 5 years or something.
Maybe.
You could take out because every year people are putting in $5,000, so it's $15,000, it's
Exactly.
$20,000. So let them play with what
Exactly.
they want, but they have to keep their $5,000.
So someone like yourself, that might be if you should be doing a tax.
Thank God that's one thing I'm willing to do.
There you go. And the nice thing is if you put a stock or a mutual fund in there where it produces dividends or interest, you won't be taxed on any of that. As well, you won't be taxed on any capital gains. So it's just it's an all-round excellent vehicle to either complement an RSP or, in the case you're chatting about, replace.
And how do you not get taxed on capital gains? Capital gains
so you put
can
in
be taxed. If you own a second home, you are charged capital gains because it's not your primary residence.
Right.
And then you pay tax on that. Am I correct on that?
That's correct.
And so you just said, but you can save your capital gain. What do you take the capital gains? You put it in your tax-free account. Is that what you're saying?
Just so I'm not.
Or your RSP.
So if you put $5,000 into your tax-free savings account and it grew to $10,000,
yeah.
you will not be taxed on that $5,000 growth. Whether capital gains, dividends, or interest, you will not be taxed on any of that growth within a tax-free savings account when you withdraw it. That's the advantage of it. Now, I think what you're alluding to is what if you had a secondary property? Could you put that into your tax-free savings account? No. They have sort of rules as to what can go in there, and that probably wouldn't work.
Right. Okay. So the pros of an RSP is that you get a tax break.
Correct.
But is it not true that you get the tax break for the here and now?
Right.
But later on, you pay the tax.
You pay the tax.
So pay us now or pay us later.
Pay us later. Exactly. And that's why. And so there's the other issue. And I have spoken to people who I have told them you have too much money in your RSPs.
Have you really? And how much money did they have, John?
Well, so
You're not naming names.
I'll give you an example. I meet a lot of these IT consultants. There's a big chunk of my business who started, graduated from the University of Waterloo at the age of 23, went to work, started making $50,000, $60,000 a year. They're now 40 years old. They're making $140,000, $150,000. They've been doing 10% every year, and they've got their $150,000 in there, and they keep throwing in $10,000 a year.
Right.
I said, do you know what this is worth at 71? You're worth about $2.5 million. And they go, fantastic. And I said, well, that's great, but are you aware that at 71, you're going to have to start drawing out about 7% of this, which means your income in retirement will be $150,000, $200,000 a year. You're going to be in a worse tax bracket in retirement than you are now. That being said, not everyone's in that position. So those people should look at other options. There are other options above and beyond RSPs. which is a whole other show. You know,
Yeah, which is a whole
yeah,
other
you can
show.
take out. There are little tricks out there. You can take out a loan for investment purposes in non-registered assets, and you can deduct the interest on that loan, similar to an RSP, and you can put it into an investment where it doesn't trigger any interest or dividends because it's capital class. So it only triggers unrealized capital gains, which means you don't pay any tax until you sell it. So effectively what you've just done is you've taken out a loan, very scary thing, not for everybody as well.
That's for sure.
And you've deducted the interest, similar to an RSP, and you've created assets that don't trigger any tax. Or and if they do, they create capital gains, which is my preferred tax, because they actually care what you put into it. And they only tax 50% of the gain. So there are some tricks. I don't really want to get into that on this show because it's not really what we want.
It's RSP time.
It's RSP time.